You know what nobody's talking about right now? The fact that silver just crossed a threshold that's never been crossed before in human history. And I'm not talking about price. I'm talking about something far more fundamental. Something that's going to make the next 18 months absolutely critical for anyone holding physical metal. Let me show you what I mean. In 2024, industrial demand for silver hit 654 million ounces. That's not the interesting part. The interesting part is what happened in the first quarter of 2025. Industrial consumption jumped another 11% year over year. We're now looking at a run rate that's going to push industrial demand alone past 720 million ounces this year. And here's the kicker. Total global mine production, 830 million ounces. You see where this is going? For the first time ever, industrial demand is consuming nearly 87% of all newly mined silver. Not jewelry, not investment, just industrial applications. Solar panels, electric vehicles, 5G infrastructure, medical devices. The stuff that keeps modern civilization running. And unlike investment demand, which can disappear overnight when sentiment shifts, industrial demand doesn't care about your feelings. It doesn't care about the stock market. It doesn't care about interest rates. It just keeps growing, because the technology revolution demands it. But here's what makes this absolutely fascinating. Go back to 2020. Industrial demand was sitting at 486 million ounces. In 5 years, we've added 234 million ounces of annual industrial consumption. That's a 48% increase, and it's accelerating. The solar industry alone is now consuming 180 million ounces per year, up from 101 million in 2020. Electric vehicles? They went from 35 million ounces to 88 million ounces in the same period. Every Tesla Model 3 contains between 25 and 50 grams of silver. Every solar panel installation requires about 20 grams per panel. And the world is installing solar panels at a rate of 400 gigawatts per year now. Let me paint you a picture of what's happening right now in China. They just announced their 2025 renewable energy targets. 300 gigawatts of new solar capacity this year alone. That's 120 million ounces of silver demand just from Chinese solar installations. In 1 year. From one country. And that's before you factor in their EV production, which is running at 9 million units annually. Another 45 million ounces right there. Now, you might be thinking, okay, but can't they just mine more silver? Great question. Let's talk about that. Global silver mine production peaked in 2016 at 900 million ounces. Since then, it's been declining. We're down to 830 million ounces in 2024. And the projections for 2025 show another 2% decline. Why? Because 72% of silver comes as a byproduct of mining other metals: zinc, lead, copper, gold. When those operations slow down or become unprofitable, silver production drops automatically. And right now, we're seeing base metal mines shutting down across South America because of declining ore grades and rising costs. Peru, the world's second-largest silver producer, just reported a 7% decline in silver output for 2024. Mexico, the largest producer, saw a 4% drop. These aren't small numbers when you're already running a deficit. And here's something that should terrify anyone paying attention. The average ore grade for primary silver mines has fallen from 12 ounces per ton in 2005 to just 6 ounces per ton today. You're digging up twice as much rock to get the same amount of silver. The economics are getting brutal. But wait, there's more. And this is where it gets really interesting. The above-ground stockpiles that everyone assumes will fill the gap, they're vanishing. The COMEX registered silver inventory, the stuff that's actually available for delivery, dropped from 150 million ounces in early 2024 to 68 million ounces today. That's a 55% decline in 14 months. The eligible category, which is silver sitting in COMEX warehouses but not available for delivery, is at 260 million ounces. Sounds like a lot, until you realize that industrial users consume that much in 4 months. And here's something that nobody's connecting yet. The London Bullion Market Association just reported that silver holdings in their vaults dropped to 890 million ounces. That's down from 1.1 billion ounces 2 years ago. Where did 210 million ounces go? It went into solar panels in Germany. It went into EV batteries in California. It went into 5G infrastructure in South Korea. And it's not coming back. Once silver gets used in industrial applications, it's gone. The recycling rate for industrial silver is only 15%. It's too dispersed, too expensive to recover. Let me tell you a story about what happened in 2011. Silver hit $49 an ounce in April of that year. Everyone remembers that. What they don't remember is why it crashed back down to $26 by September. Investment demand collapsed. The Hunt Brothers 2.0 narrative fell apart. Margin requirements got raised 5 times in 2 weeks. Speculators got flushed out. But here's the critical difference between 2011 and now. In 2011, industrial demand was only 487 million ounces. Investment demand was driving the price. When investment demand disappeared, the price collapsed because there was no fundamental floor. Today, industrial demand is 720 million ounces and climbing. That's a 48% increase from 2011 levels, and it's not speculative. It's not leveraged. It's actual physical consumption that's never coming back to the market. So even if investment demand disappeared tomorrow, you've got this massive industrial bid sitting underneath the market that didn't exist in 2011. That's your floor. And that floor is rising by 50 million ounces every single year. Now, let's talk about what this means for price. And I want to be really careful here because I'm not making predictions. I'm just showing you the math. Current silver price is around $32 an ounce. At that price, the total value of annual mine production is $26.5 billion. The solar industry alone is generating $4.8 trillion in annual revenue. The EV industry? $500 billion. These industries are spending $26.5 billion on all the newly mined silver in the world. And that silver represents less than 0.5% of their total costs. You see the problem? If silver went to $50 an ounce tomorrow, it would add maybe $3,000 to the cost of a solar installation that costs $200,000. It would add $45 to the cost of a Tesla that sells for $45,000. Nobody would even notice. But at $50, you'd see every silver mine on the planet running at full capacity. You'd see exploration budgets triple. You'd see new projects that are currently uneconomic suddenly become viable. The supply response would be massive. But here's the thing. That supply response takes time. It takes 7 to 10 years to bring a new silver mine online from discovery to production. And right now, there are exactly 0 major new silver projects in the pipeline that will come online before 2030. 0. The last major primary silver mine to open was Tahoe Resources' Escobal mine in Guatemala in 2013, and that got shut down by the government in 2017. We haven't replaced that capacity. So you've got demand growing at 7% annually, supply declining at 2% annually, and no new major supply coming online for at least 5 years. The math is pretty straightforward. Either price has to rise enough to destroy demand, which seems unlikely given how critical silver is to the energy transition, or we're going to see actual physical shortages. Not paper shortages on the COMEX, real shortages where solar panel manufacturers can't get the silver they need. And this is already starting to happen. In March 2025, First Solar, one of the largest solar panel manufacturers in the world, reported that they're now securing silver supply through 3-year forward contracts at prices 15% above spot. Why would they do that? Because they're terrified of not being able to get the metal. They're essentially paying a premium for supply security. That's not normal market behavior. That's shortage behavior. Let me tell you what happened in the palladium market in 2019. Palladium is used in catalytic converters for gasoline cars. Auto production was booming. Mine supply was flat. Palladium went from $1,000 an ounce in 2018 to $3,000 an ounce by early 2020. A 200% increase in 18 months. And that was with industrial demand of only 10 million ounces per year. Silver's industrial demand is 72 times larger. If silver did what palladium did, we'd be looking at $96 an ounce. And I'm not saying that's going to happen. I'm just showing you what happens when industrial demand overwhelms supply in a critical metal. Now, here's where this gets personal for a lot of people. If you're sitting on retirement savings, if you've got $100,000 or more in traditional accounts, you need to understand what this silver situation means for the broader precious metals market. Because silver doesn't move in isolation. It moves with gold. And when silver starts moving because of industrial shortages, it tends to drag gold along with it. I put together a free guide on how gold IRAs work, how you can get physical gold into your retirement account without tax penalties, how the whole process actually works. It's in the description below. Worth checking out if you're thinking about protecting some of your wealth with physical metals. But back to silver. Let's talk about what the smart money is doing right now. And by smart money, I mean the people who actually understand industrial supply chains. In January 2025, Sprott Physical Silver Trust, which holds physical silver for investors, reported inflows of 8.2 million ounces. That's the largest monthly inflow since April 2021. Who's buying? According to their filings, it's primarily institutional investors and family offices. These aren't retail speculators. These are sophisticated players who've done the math on industrial demand. And then there's what's happening in India. India is the world's largest consumer of silver for jewelry and industrial applications. In 2024, they imported 287 million ounces of silver. That's up from 198 million ounces in 2023, a 45% increase in 1 year. Why? Because their solar industry is exploding. They're targeting 500 gigawatts of solar capacity by 2030. That's going to require 200 million ounces of silver per year just for Indian solar installations. Where's that silver going to come from? Here's something that should make you pause. The Silver Institute, which tracks global supply and demand, just released their 2025 forecast. They're projecting a deficit of 215 million ounces this year. That's the largest deficit in recorded history, and their forecast assumes that investment demand stays flat. If investment demand picks up even slightly, that deficit could hit 300 million ounces. To put that in perspective, the entire COMEX registered inventory is only 68 million ounces. The deficit is 3 times larger than all the silver available for immediate delivery in New York. Now, let's talk about what happens when deficits persist, because we've seen this movie before. In 2004, silver was running a deficit of about 70 million ounces per year. The price was $6. By 2008, the price had hit $20. That's a 233% increase over 4 years with a deficit that was 1/3 the size of what we're looking at now. And that was before solar panels were a thing. That was before EVs were a thing. That was before 5G was a thing. But here's what's really fascinating. Back in 2004, above-ground stockpiles were massive. There were billions of ounces sitting in government stockpiles, in private vaults, in old film photography supplies. Those stockpiles absorbed the deficit for years. Today, those stockpiles are gone. The U.S. government sold off its strategic silver reserve in 2002. China sold most of theirs between 2003 and 2014. The film photography industry, which used to consume 200 million ounces per year, is dead. That silver got recycled and absorbed into industrial applications. There's no buffer left. And this is where the COMEX situation gets really interesting. The COMEX silver market trades about 150 million ounces per day in paper contracts. That's more than the entire registered inventory turning over twice a day. It's a massive paper market sitting on top of a tiny physical market. And as long as nobody asks for delivery, it works fine. But what happens when industrial users start demanding physical delivery because they can't source silver anywhere else? We got a preview of this in March 2020. During the COVID panic, the spread between paper silver and physical silver blew out to $8 an ounce. You could buy paper silver for $14, but if you wanted actual physical silver coins or bars, you were paying $22. That's a 57% premium. And that was just from retail investment demand. Imagine what happens when industrial users, who need hundreds of millions of ounces, start competing for physical metal. Let me tell you about what's happening in the solar industry right now. The average solar panel contains about 20 grams of silver. That's 0.64 troy ounces. At current prices, that's about $20 worth of silver per panel. The panel sells for $200, so silver is 10% of the panel cost. Now, solar manufacturers have been working on reducing silver content for years. They've gotten it down from 30 grams per panel in 2016 to 20 grams today. But here's the problem. They're hitting physical limits. You need a certain amount of silver to conduct electricity efficiently. Below a certain threshold, the panel's efficiency drops, and you lose more in power output than you save in silver costs. And the solar industry is in a race right now. China is subsidizing solar panel production to the tune of $50 billion per year. They're trying to dominate the global market. But they need silver to do it. And they're competing with their own EV industry for that silver, and their 5G build-out, and their consumer electronics manufacturing. China consumes 240 million ounces of silver per year. That's 29% of global mine production. And their demand is growing at 12% annually. Here's a question nobody's asking. What happens if China decides to secure silver supply the way they secured rare earth supply? What if they start stockpiling? What if they restrict exports of silver-containing products? They've already done this with gallium and germanium. They've done it with rare earths. Silver is just as strategic for the energy transition. And China produces 14% of the world's mined silver. If they decided to keep that silver for domestic use, that's 116 million ounces that disappears from the global market overnight. Now, let's talk about the investment side of this equation. Because right now, investment demand is actually pretty weak. Silver ETFs saw outflows of 45 million ounces in 2024. Retail buying is down. Sentiment is terrible. Everyone's focused on Bitcoin and AI stocks. Nobody cares about silver. And that's exactly why this setup is so interesting. Because when industrial shortages start making headlines, when solar manufacturers start publicly complaining about silver availability, investment demand is going to wake up. And when it does, you're going to see a buying panic that makes 2011 look tame. Think about the psychology here. Right now, most investors don't even know there's a silver supply problem. It's not on their radar. But once it becomes obvious, once the deficit shows up in the form of actual shortages, you're going to see a rush into physical silver that overwhelms the available supply. And unlike 2011, when investment demand was driving the move and there was no fundamental support, this time the industrial bid is going to provide a floor. Every dip is going to get bought by industrial users who need the metal. Let me give you a specific example of how this could play out. Let's say we're in September 2025. Silver is at $35. First Solar announces they're having trouble securing silver supply for their 2026 production schedule. The stock drops 15% in one day. Other solar manufacturers start making similar announcements. Suddenly, silver supply is front-page news. Investment demand kicks in. Silver ETFs see inflows of 50 million ounces in a month. The price jumps to $42. That triggers stop losses and momentum buying. We're at $50 by November. At $50, industrial users panic and start forward buying everything they can get. The COMEX registered inventory drops to 30 million ounces. Premiums on physical silver blow out to 20% over spot. We're at $65 by January 2026. Is that going to happen? I have no idea. But the setup is there. The fundamentals are there. The deficit is real. The industrial demand is real. The lack of new supply is real. All you need is a catalyst to make it obvious to everyone else. And here's what makes this different from every other commodity shortage we've seen. Silver is unique because it's both a monetary metal and an industrial metal. When there's a shortage, you get buying from two completely different groups. You get industrial users who need the metal for production, and you get investors who see it as a store of value. Those two sources of demand feed off each other. Industrial buying drives the price up, which attracts investment buying, which drives the price higher, which causes more industrial panic buying. It's a feedback loop. We saw this exact dynamic play out in palladium. When auto manufacturers realized they had a supply problem, they started forward buying. That drove the price up. That attracted investment funds. That drove the price higher. That caused more industrial panic. The price tripled in 18 months. And palladium doesn't have the monetary metal aspect that silver has. Silver has 5,000 years of history as money. When the price starts moving, that history matters. Now, let's talk about what this means for gold. Because silver and gold are joined at the hip. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting at about 88 to 1. Historically, that ratio averages around 60 to 1. When silver starts moving because of industrial demand, that ratio is going to compress. If gold is at $2,800 and the ratio goes to 60, silver is at $46. If the ratio goes to 40, which is where it went in 2011, silver is at $70. And that's assuming gold stays flat, which it won't. Because when silver is moving on industrial shortage fears, gold is going to be moving on monetary debasement fears. Here's the thing about gold. Central banks bought 1,037 tons of gold in 2024. That's the second highest annual purchase on record. They're not buying because they think the dollar is strong. They're buying because they see what's coming. They see the debt levels. They see the deficits. They see the political dysfunction. And they're preparing for a monetary reset. When that reset comes, gold is going to reprice higher. And when gold reprices higher, silver is going to leverage that move because of the industrial shortage. So you've got this perfect storm setting up. Industrial silver demand is overwhelming supply. Investment demand is dormant but ready to wake up. Central banks are accumulating gold. The dollar is losing reserve currency status. The BRICS nations are building alternative payment systems. The debt bubble is reaching terminal velocity. And nobody's paying attention because everyone's distracted by the stock market hitting new highs. Let me tell you what happened in 1979. Gold was at $200. Silver was at $6. The gold-silver ratio was 33-1. Inflation was running hot. The dollar was weak. The Hunt brothers started accumulating silver. By January 1980, gold hit $850 and silver hit $49. The gold-silver ratio compressed to 17-1. Silver outperformed gold by a factor of 4-1. Now, I'm not saying we're going to see a Hunt brothers situation again, but I am saying that when silver moves, it moves violently. And the setup today is far more compelling than it was in 1979 because you've got actual industrial demand supporting the move. Here's what's keeping me up at night. The solar industry is projecting 600 gigawatts of new installations per year by 2027. That's 240 million ounces of silver demand just from solar. The EV industry is projecting 30 million units per year by 2027. That's 150 million ounces of silver demand just from EVs. Add in 5G, medical devices, consumer electronics, and you're looking at total industrial demand of 900 million ounces by 2027. Mine production? Optimistically, 850 million ounces. That's a 50 million ounce deficit before you even count investment demand. And investment demand is going to come back. It always does. When silver was at $14 in 2020, nobody wanted it. By February 2021, it hit $30 and everyone was trying to buy. The Reddit crowd tried to squeeze it. Retail demand went through the roof. Premiums on physical silver hit 40% over spot. You couldn't find silver eagles anywhere. And that was just retail demand. Imagine what happens when institutional money decides silver is the play. Because here's the thing about institutional money. They move in herds. Right now, they're all in AI stocks and Bitcoin. But when the narrative shifts, when silver becomes the story, they're going to pile in all at once. And the silver market is tiny compared to other markets. The entire above-ground silver inventory is worth maybe $600 billion at current prices. That's less than Apple's market cap. If just 1% of global investment capital decided to allocate to silver, that's $1.5 trillion trying to buy a $600 billion market. The price would go parabolic. Now, I want to be clear about something. I'm not telling you to go out and buy silver. I'm not giving financial advice. I'm just showing you what's happening in the market. I'm showing you the supply and demand fundamentals. I'm showing you the industrial trends. I'm showing you the deficit. What you do with that information is up to you. But I will say this. If you're not paying attention to silver right now, you're missing one of the most compelling supply-demand setups in any commodity market. This isn't speculation. This isn't hopium. This is math. Industrial demand is consuming 87% of mine production and growing at 7% per year. Supply is declining at 2% per year. There are no new major mines coming online. The deficit is 215 million ounces and growing. The COMEX inventory is at multi-year lows. Above-ground stockpiles are depleted, and investment demand hasn't even woken up yet. When this thing breaks, it's going to break fast. And by the time it's obvious to everyone, the easy money will be gone. The people who are going to profit from this are the ones who see it coming before it's front-page news. The ones who understand that industrial demand doesn't care about sentiment or technical analysis or what the Fed is doing. It just keeps growing because the technology revolution demands it. So, watch the COMEX inventory. Watch the solar installation numbers. Watch the EV production numbers. Watch the mine production reports. Watch the Silver Institute deficit projections. And most importantly, watch what the smart money is doing. because they're already positioning for what's coming. The question is, are you?